The IRS is salivating over your 401k and IRA money. You've been deferring taxes all these years, and they are not so patiently waiting to take up to almost 40% of your balance. So if you're getting ready for retirement and you have all or nearly all your investment money in pre-tax accounts like a 401k or an IRA, I'm going to show you how to keep more money in your pocket and less in Uncle Sam's. There are two quick ways to completely avoid taxation on IRA withdrawals. And the first strategy is called qualified charitable distributions. If you're someone who routinely gives money to charity and you plan to continue to give charitably in retirement, you can give money directly to charity from your IRA and not pay any taxes on the distribution. The IRS is completely cut out of the equation and they don't see a cent in taxes. Now, there are a couple of rules. For example, you need to be over the age of 70 and a half to use a strategy like this. But even if you're not that age just yet, you can plan on using this strategy in the future. There's one other way to distribute money from your IRA without paying taxes, and it's a rule most people don't know about. If you have an HSA account, there is a once-in-a-lifetime rule that allows you to move money from your IRA into your HSA. Now, there are a lot of conditions that need to be met in order to capitalize on the strategy, but for those that can do it, it can be a powerful way to shelter some money from the IRS. Because as you may know, money inside an HSA grows tax deferred, and distributions from an HSA account for qualified medical expenses are tax free. Now let's look at the main strategy, and this is how we help keep more money in our clients' pockets and help them avoid overpaying the government. All right, you've probably heard about Roth conversions and the benefits of them. So I'm going to show you how we evaluate if Roth conversions will actually save you money and when they can actually cost you more money than they're worth. So I want you to meet Mike and Sarah. They are 63 and they are about 2 years out from retirement. And what we're looking at here is a big picture look of their net worth and all the assets and income they're going to have available to them in retirement. And so right now they're still working because they're 63 and they'll be working for another 2 years. Between the two of them, they make about $300,000. The good news is that they are maxing out both of their 401ks. And so as we can see, the combined total for 2024 is about $61,000 in terms of what they're putting into their 401k. If we take a look at their expenses, their monthly expenses are about $7,500 a month, and they would like to continue that level of spending throughout retirement adjusted for inflation. Now, they do have some other pretty big expenses in their life that they want to make sure that they can maintain. And one of those expenses is vacations. It's a pretty good sized amount, about $18,000 a year. And you know, for Mike and Sarah, they told us, look, traveling is super important, not just for ourselves, but we love taking family and friends and really making this into an experience. They were less about material things and more about the experiences of life. And so we really wanted to make sure we prioritize that in their plan. And the other thing you're going to see here is tithing. Giving was incredibly important to them. And so while in their working years, we're accounting for their tithe, but they wanted to continue that giving even into retirement. So what I'm going to do is here, I'm going to move this slider over, let's just say to that first year of retirement. And what you'll see here is that giving will continue. It's going to be a little bit less than their working years, but nonetheless, they wanted that to continue. And of course, we're considering for taxes, right? Taxes are a really big chunk of their expenses while they're working. So we're counting things like federal tax and state tax because they do live here in California, and also other things like FICA tax. Now, in terms of assets, what we're working with in terms of their investment portfolio for retirement, they have about 1.9, almost $2 million in investable assets, but the bulk of that money is in pre-tax retirement accounts, right? They only have $200,000 in a joint taxable account, and then the rest of that money is in IRA accounts. And that's something that we're looking to see, how can we bring down their lifetime tax bill? Because this is going to be a big problem for them down the road, as we're going to see as we go along in this video here. Now, in terms of income in retirement, for their specific plan, we're looking at delaying taking Social Security until 70, because as we're going to look at, we're going to see the benefits of doing some Roth conversions once they retire and looking to do Roth conversions until they start Social Security at age 70. So you'll see here, as I move through their retirement, age 68, age 69, no Social Security benefits just yet. Then once they turn 70, we turn on those benefits. And they actually did want to wait until 70 to lock in those highest lifetime benefits. And one more thing I'll just mention about their investment portfolio, because this is important as we look at projections. Their current allocation mix was about 60% stocks and roughly 40% bonds. So again, Mike and Sarah knew they had a tax bomb ahead of them. And if your situation looks anything close to theirs, you probably know that as well. So now that we have an understanding of their net worth and their balance sheet, what we're going to take a look at now is a multi-year forward-looking tax plan. But first, let's evaluate what their tax situation might look like if they follow that traditional pathway, which is taking money first out of taxable investment accounts and then moving on to the tax-deferred accounts like an IRA or a 401k. Now, what we'll see is this year, while they're still working, right, most of their taxable income, almost all of it, is coming from earned income. And that's going to be the case for 2024, 2025. Now, when they retire in, let's just say 2026, they retire partway through the year is what we're showing, right? So most of the taxable income is still going to come from their W-2, but then we start taking out some income from their investment accounts. And then we move into 2027, right? They're fully retired. So now we don't have any more W-2 income. We're fully relying upon their brokerage account. But if we follow this pathway, once we roll into 2028, that brokerage account is completely wiped out. And then we have to fully rely upon their pre-tax retirement accounts. And you can see that here, if we take a big picture look at their taxes, just visually over their lifetime, we can see taxes are super high when they're working, and then they're going to drop down and feel almost non-existent for those beginning years, which might feel good initially, but as we see, taxes will really, really ramp up. They're low right here because this is when they start Social Security at age 70, and so they don't have to rely too much on their pre-tax retirement accounts. But like I mentioned at the beginning of the video, the IRS is not so patiently waiting to take your IRA and 401k money because they're not going to let you defer the taxes forever. You have to start required minimum distributions, and that's exactly what you're seeing here. And that's why their taxes are expected to be so high in the later years of retirement and just continue to ramp up. So we knew that this was not necessarily the optimal plan. So what we did again is we took a multi-year approach and we looked and we said, all right, let's evaluate a strategy in which we do some Roth conversions. But like I mentioned earlier, there's an art to this because you can over-convert and actually pay more taxes and have less money. So there is a sweet spot in doing this. And what we'll see here is that doing Roth conversions up to the 24% bracket is projected to be the best option and help them pay the lowest lifetime tax bill. As we'll see here, following the traditional pathway of fully depleting the taxable account or the brokerage account first, and then moving on to your tax deferred accounts, they're projected to have total taxes over their lifetime of about $1.28, almost $1.3 million of total tax. However, if they were to strategically do Roth conversions once they retire up to the 24% bracket, their projected lifetime tax bill is expected to go down to about $842,000, right? That's a really big difference. And think about what could you do with all that additional tax savings? How might your retirement look different? So again, for us to see these numbers just really simply on screen, what we'll do is we'll implement this and you'll see that their projected total lifetime tax bill is expected to go down by $1.1 million by implementing this strategy. Now, of course, the numbers I'm showing here are what are called nominal numbers. That means they're adjusted for inflation. Sometimes it's helpful to see numbers in real terms, like what does that actually mean in today's dollars? It makes it a little bit more realistic. And what that means is that's about $437,000 in saved taxes over their lifetime just by using a simple strategy like this, but doing it in the sweet spot. And now you might be asking yourself, well, if the 24% bracket helps save their taxes, What about going up maybe to the 32% bracket or the 37% bracket? Shouldn't that save even more taxes? And what we'll see here is that no, that is not the case. If they were to convert, let's just say up to the 32 or 35% bracket at the time of retirement, their projected lifetime tax bill is actually expected to be a little bit higher. So there can be situations in which you do too much converting to Roth money, and it's actually detrimental to your lifetime tax bill. Now, this might all sound great, and you're saying, that looks fantastic. Let's just convert up to the 24% bracket. You've shown us that's the sweet spot. That's gonna help us pay the lowest amount of lifetime taxes. But the truth is, Roth conversions of this amount are not for the faint of heart. Because as we're gonna see here, if we look at a situation in which we are converting up to, let's just say, the 24% bracket, what we're going to see here is that their tax bill at the time of converting between federal taxes and state taxes, and that first year conversion is going to be over $120,000, and the next year almost $120,000. That's a really big tax bill. And it's one thing, and I understand people say, oh, just convert to the 24% bracket. But I like to take these percentages and apply them to real world numbers, right? If you see a tax bill of $120,000, that sounds a lot different than just saying, just convert up to the 24% bracket. Because what that would mean in terms of conversion, as we'll see in that first year of conversion, is in 2026, we'd be looking at converting over $265,000 to the Roth. And in the following year, that'd still be over $200,000 of Roth conversion money. That's a lot for most people. And now we would use their brokerage account to help pay for these tax bills, but nonetheless, that brokerage account wouldn't last for very long, even at these size of Roth conversions. And so that's why, my job as a financial advisor is to not only take what might be most mathematically optimal, but then take a look at your specific situation and say, what is the most realistic, right? Because what we can do now is we can compare a strategy of saying, well, 24% might be most optimal, but let's look at converting up to the 22% bracket, right? It still gets us really close. It helps reduce that lifetime tax bill. But what you're going to see here is that they're still going to pay a lot of money in Roth conversions, but that tax bill can be a little bit more palatable, right? Sometimes choosing the very good strategy that you can stick with is better than the absolute best strategy that there's no way you're going to do because the numbers scare you. And I did not model this here, but one other main consideration we did with this client is calculate how much they plan to give in retirement after age 70 and a half, and actually keep around that amount of money in their IRA. In other words, we would not convert that amount to a Roth, because if you remember qualified charitable distributions, that strategy of giving money directly out of your IRA over to the charity is a non-taxable event. So yes, it does pay to do the math and figure out which strategy will help you pay the lowest lifetime tax bill. And this is the kind of stuff we help our clients with looking to retire and keep the most dollars in their pocket. If you'd like to learn more about how our team of retirement planning specialists can possibly help you, you can visit our website in the description below, schedule a call with one of our certified financial planners. Now, I've shown you a lot of information, but I've left out a crucial aspect. And that's how to actually invest to create the systematic and reliable income that Mike and Sarah need for retirement. Because whether we like it or not, how investments perform can have a massive impact on the quality of your retirement. If you want to know what investment strategy is best for retirement, then you'll want to watch this video right here. Once again, this is Alex Okagawa, financial advisor and partner here at 1 Degree Advisors. And if you're interested in learning more about our team and how we can help you, visit our website at onedegreeadvisors.com.